How's everyone doing? Thanks for all the support. So basically, what I want to do is show vets that finances shouldn't be a huge worry. It is. That's what most of us worry about: relationships, finances, like our mental health. What I want to do is try to take one of those things off your plate, like the same way I did it. Read some books, watched some YouTube videos, did some studying. Hard to understand, it really is, until you put into terms that you can understand. Once you put into terms that you can understand, it's easy. It's complicated, but it's easy once you understand how to do it. Just like everything else we've done in our careers, it was hard until we understood how to do it. Once we understand how to do it, we become experts in it. So basically, what I did was create a stock targeting cycle, like how to find stocks, how to alleviate all the noise that you don't need to listen to, and just trade. Because I don't invest when I'm doing this. Investing is me looking at fundamentals long term and investing 10, 20, 30 years from now in a stock that's going to show value and growth over the long term. Warren Buffett style. I'm not trying to do that. What I'm trying to do is trade and make money in the now, not in the later. Those are other accounts. You should always have those other long-term accounts, that dividend accounts, leap accounts, stuff like that. And I'll get into other videos about stuff like that. But you always have backups of your backups. 2 is 1, 1 is none. This is one of 2 or 3 accounts that you should be trading in to increase profits over the short term. You need to invest for the long term and invest in those good companies. That's the Warren Buffett way. That is the way it should be done. You can't doubt it. So again, I'm going to try to show you how to do stuff in the short term to create that monthly income, that monthly money, that yearly money, whatever you need to make yourself feel better and know that everything's going to be okay. Because at the end of the day, if you learn how to do this, you could be homeless with $500 in an account and a cell phone, and you're going to be okay. Because you're going to learn how to make money. And that's all I want to help people do. So with that, we're going to start with the whole cycle, the stock targeting cycle. We're going to find a stock. We're going to fix it. We're going to finish it. We're going to exploit it. We're going to analyze it. And we'll disseminate it. So we'll go with number 1. How do we find the stock? All right. Again, we're trading. We're not trying to invest. So take the company name out of the situation. Everyone wants to own Apple, Microsoft, stuff like that. Who cares what the name is? What I'm going to show you how to do is option trading, where I'm just looking for it to make $1 or $2 increase in either direction, because I can buy calls or puts. And then I'm going to analyze and figure out how much money I got to put into it to make $300 or $400 per trade. Then I'm done. I cash out and I'm done. If you can do that 3 times a week, make $300 off one trade, taking 10-15 minutes of your day to do some analysis and figure out how to track and trap it and know when the breakout's coming out, 3 times a week, that's almost $1,000 a week. Times 4, that's $4,000 a month. That clears $100K a year almost if you can just calm down, figure out how these minute differences work. So basically, how we find the stock is the news, social media. News and social media. If you look at GameStop and AMC, besides all the underlying issues with the short squeeze and everything like that, the only reason people got into it is because news and social media. Same thing. Watch the news. Watch social media. What are people buying? What are people selling? Follow into the trends. That's what it goes into. If everyone is doing X, it's a fine line of that fear of missing out. But if you can get in early enough, and we're not looking at the name GameStop, not the name AMC, and we can figure out how it traps, and I'll get into it later, we can make money off it, but it's more risky. What I'm trying to show you is how we can make money off the stocks that have low IV, move $1 or $2, maybe 3 or 4 a day. You can make money off them every single day as long as you can plan it for it accordingly. So the 4 to 5 stocks you know well. Like when you invest, it's your span of control. Just like the military. The reason why we have squads, teams, platoons, hierarchy is because we can only control so much. Our brain can only handle so much. So what you need to realize is you don't have to analyze the entire market every single day and watch every single stock. Get good at 4 or 5 stocks. 4 or 5 stocks that you have interest in. If you're a gamer and you like playing video games, Activision. If you like Microsoft or games like that, Microsoft. Apple. If you own iPhones like everyone else does, Apple. Because what you're doing is, even though you know the names of the stock, you go take the names out of it eventually, and you're learning the patterns of what they do. Because they're really well established, and the way institutions trade them back and forth, along with what the population and social media says, will dictate the price of the stock. So then, all you gotta do is wait for $1 price movement, and then you can track it, and make your money. Market Watch is another one with TSTs. So like quick dollars, like large up and down movements, 50% or higher. When you see stocks that do stuff like that, like a stock that jumps up 300% in one day, why? Why did it jump 300%? Is it because GameStop's being shorted and now you're riding the trend up? Don't join that, because it's an anomaly. It doesn't make sense to what should be happening. So you wait. And then once it peaks, because you're following patterns, now you can short it, or not short it, you can buy puts on it, because we're not selling stuff we don't have. We're going to buy a put on it. I'll show you how to do that in the next episode. You just wait for it to come down, because it should have been doing that. It doesn't make any sense. So again, we're taking the name out of it and looking at a technical analysis of what it's doing and writing those trends. Because at the end of the day, something that goes up $400 or 400% in one day has to retrace. It doesn't make sense. The VWAP and that price are totally different, and I'll get into that, because they have to meet at some point. It's going to cost money because of the IV, but you can make a crap ton of money on it on options with each dollar movement. So now, once we put all that together, we figure out what's trending, what's going on, or we're just searching. Now we know these 4 or 5 stocks. Like, we always have options. If I can't find anything going on in social media or the news, let me revert to those 4 or 5 stocks I already know, and then let me go. That's my fallback. Because at the end of the day, I know the patterns, I've studied them long enough, and I can make something happen with that. So now when we want to fix it, alright, price, volume, IV, pattern life, volume over open interest, alright? So again, we're looking for those patterns in these companies that we know or are moving well. So price range, we're looking at the highs, the lows, the openings and closings. Because if it opens at $100 but closes at $90, the next day it opens at $95 but closes at $89, that's a downward trend. We're seeing the sellers win over the day period. Now, we can do intraday trading, but we're not using margin accounts. We're not day trading. We're using cash accounts, and I'll get into that in the next episode, the 25 rules of a stock fight. Always use cash accounts, because you don't want to play with more money than you can lose. So we're looking at those things. The volume. Volume, if you look at it, is the fill artillery of the stock market. If the volume is 500 for 5 million every single day for 3 weeks, and all of a sudden it's 10 million, something happened. Either we go back to the news and social media and see which way it's going, because they're bringing the field artillery to knock that price up or down, depending on the buyer's or seller's situation. So we always want to look at the volume, because that's the amount of times it exchanges hands. It doesn't matter back and forth who buys or who sells, but someone brought the artillery in. And then now that reverts back to the trends we're going through and figure out that pattern of life. Because we can look back is, when's the last time the volume and the fill artillery has been brought in? What did it do 3 months ago? That's your SIGAX, your comparison of the pattern of life. If 6 months ago this stock has been trading in this range, all of a sudden the fill artillery has been brought in and now is dropping, the sellers are winning. Why? We want to know why, because we want to know how much we can go lower. The IV, the implied volatility, sorry, second language, but the IV basically shows how much that average moves from the average price up and down. So say the stock is about $100 and the IV is 10%. That means 105 to 95 is the range that stock is trading over that given period of time, which is a low IV, is kind of what we want because we can trap better. Tesla, GameStop, all those things had IVs of 700, 1,000 IVs. That means if it was trading at $100, it can go up 500% in one direction and 500% in the next direction. So it's very hard to trap that stock. All right, all options are speculative, but IVs like that are beyond speculative because it can just drop and flow. You can see the GameStop, it goes up and down. Tesla does the same thing. There are IVs in the 500s or 600s. That's why you can make a lot of money in option calls, but you're risking a lot because the moment it drops below and goes this way, your calls are worthless. Like you're losing the money right away. So what I'm trying to do is show you how to narrow down to like 40% lower, because all we're looking for is $1 or $2 price movement to lock in our $300 gains for that day. Because $300 a day times the entire trading period of a year, you're going to clear 6 figures if you can just do that. Average. So the pattern of life, that's your candles. So your candles, the Japanese candles, we can get into that, is how it shows you what that stock is doing, up or down. Without adding anything else to it, back in the day, in the 1870s, is how they traded the rice market back in Japan. They can tell the candle, that's how they do create a system, the price going up and down. What we have an advantage of now is we add our Western indicators, our VWAPs, our moving averages, our RSIs, combined with the pattern of life, and now we're adding more and more indicators, more and more confirmation of what that stock should be doing. So candles, volume, VWAP, price, RSI. That's really all you need to learn on how to trade options effectively or stocks effectively. If you take the name out of it and you're doing just trading, investing is totally different. When we look at options, we want volume over open interest, 3 times volume open interest. That's just supply and demand. Volume is, again, how many times it goes back and forth, how many people want it. That's your demand. Your open interest is how many people have it. That's your supply. So if you have 3 times volume over open interest, if not more, you have more people wanting what that contract you have than there are contracts written. It makes it more valuable. That's how you make money when you start fixing and finding everything, because you have to look at that. Your deltas, everything will come in. I'll show that in another video. But your open interest is key when you're buying options, because they're going to expire worthless over time if no one can liquidate them. Because most people don't hold options until expiration date. You're trying to make your money between, in the intermediate, and then you're going to sell it and let somebody else take it. So then we get to finish. Like we want to, like I'm saying, we want to tracking it and trapping it. We're following those range patterns. Depending on how we want to buy options or how we want to trade it, we're seeing what it does in that range pattern. Again, 110 to 90 bucks is what it's been doing for the past 5 months. Cool. Now we know those. We've tracked it to that. Now we want to trap it a little bit lower. So now we can follow those candles. And here's a good example for all you bow hunters out there. If I'm coming down, you see those flags and pennants. Same thing as you pull a bow. I'm not going to pull my arrow right here and have a little half triangle because my target isn't in my sight yet. I'm going to pull that bow all the way back, create that perfect point, and let my target come into my sight. Right? Same thing when they talk about pennants and flags. You have your ranges. Now you have your flags coming to a point, and you're trapping that price range right at that tip, because that gets to the next down here with moving average, RSI, VWAP, the breakout. All this coincides. So when we're looking at moving averages, it's 50, 90, and 200. If you're looking at stuff like that, if the stock is below 50, 90, and 200-day averages, the stock is going down. It's not moving higher than what it averaged before. Now, when it starts crossing the 50-day, starts crossing the 90-day, starts crossing the 200, that stock's on an upward trend, and now we're like, all right, cool. Now we analyze the pattern of life. Now we're going to trap it where we can find that breakout, because that breakout is what we're looking for at the end of the day. once it's pointed and I have my arrow pulled all the way back and ready to shoot, the only reason I'm going to pull, I can miss. I aim small, miss small, right? So I'm aiming at the heart of a deer. I know I got to hit it in a certain area, but I can be off by like 50 here and here. I can be off by 50 cents, $1 or $2 in one direction. But I'm still going to hit my target because I've done all my other breathes. I got my sight picture aligned. I know where it's at. I have a clear view at my target, and I'm going to pull that trigger. Something happens. I can't. That's all when it comes down to these breakouts. If it doesn't give you the indication that you can pull the trigger, don't. You're going to waste your arrow. You're not going to get that arrow back. But what you can do in stocks is once you start realizing those breakouts, they're called buy limits and sell limits. So basically I'm sitting there, I see my target, don't know what he's going to do yet. I'm going to set my buy limit just above that breakout because that breakout is a confirmation of that pattern of life that is doing what it's supposed to be doing. So the moment it hits that breakout, right above it, maybe 1%, is when I buy because I want confirmation to know that it's going to go up at least another $1. Same thing with the downward trend. If I'm sitting there about to pull and it confirms the downward trend, like the deer is leaving, I don't have to pull my arrow, but I can pull it on puts, knowing that it broke the downward trend, and now I can still pull my arrow and hit my target because I know I'm going to miss below it, but I'm still going to make money. I'm still going to kill my deer. So stocks are different. Options, kind of how it works. $1 or $2 movement, if you have enough contracts, will make you $300 or $400 in one $1 or $2 movement because you have to look at the deltas and all the Greeks. And I'll get into that in another episode. So now we get into exploiting. So all this is easy stuff. That's a contract or two, just you sitting there, hey, I'm going to buy one contract, all right, because I know how all this is moving. And I only want to like get my $300. You can exploit that though. Because if you know how options work and you know how to buy and sell them, now you know how to create the contracts as well. So you can exploit certain stocks by knowing their movements and knowing that you can purchase a certain amount of stocks and now you become the writer of the option contract. So now instead of gaining capital gains because you're only buying contracts, buying puts and sells, if you own the stocks, now you own covered shares and puts and you can sell them and collect a premium. So every week I can sell 600 shares of X company, collect a $250 premium, and then if I set up my thing correctly, I'll keep my $200 premium or $250 premium every Friday, and I keep my shares. Monday morning, I do it again. Until it hits that strike price that I decided to sell those shares at, I keep my shares every single time. The moment it does, as long as I bought my shares, say I bought my shares at $8, but I sold my contracts at $12. I've kept my premium every single week for $250 until the entire time. The moment it breaks out and hits $12, they have the option to buy my shares from me, but my gain is between the 8 and the 12. So that's another $2,000 or $3,000 I've made, right? But I lose my shares. Who cares? I made that money. It's X company to me. It's not. I'm not in love with the company. I'm trying to make money here. All right. Same with puts and calls. Trend continuations, calls, puts, max profits. So as you're learning how to trade options and everything, you're learning how to. 99% of people don't keep options until expiration. The moment you make, say it costs me $650 to buy one contract, I make $350 on that contract. I keep my $350 profit and I take that $650 and buy another contract like that, and I just keep rolling them as long as the trends continue because I've done my analysis on everything. I'm like, all right, cool. So I was right about the $1, but now it's going up 3 or 4 or 5 or 6. All right, cool. I'm going to sell that profit here if I want to, or I got to make those decisions. That's where the analyze portion comes in. When do I sell? Because you want to sell, you want to set your limit every single time. I'm going to sell at this point, take my profits here, maintain them. It's just like going to the gym. I want to lock in them gains, so I got to eat. So I got to get that money to go back again. Who cares if you missed out on an extra $250 or $300? The chance, like, it can always go back the other way. So lock in those gains when it starts coming up that way. Advanced stuff we'll get into in other videos. Your iron condors, your butterflies, your straddles, and strangles. It's a way to use option calls and buying and selling puts and calls to mitigate risk so that you're maintaining your income or you're maintaining that money in your account. It's just like going out on a mission. We can't go on a mission without min force, so we always have to maintain min force. The moment we lose min force, we lose our advantage in the fight. So we never want to sacrifice more money than we can move on to the next day. So you have to do your analysis, put all this stuff together, and be like, all right, cool. I have 10 grand in my account. I'm only playing with 1 grand today. Crappy, because you might only buy one contract of $700, but you know that might make you 300. It's all about stacking those pennies. No one wants to get rich slow. So if you can't comprehend that $300 in one day is a lot of money, you shouldn't be trading because that's a lot of money to everybody. That's a crap ton of money. That's $100K a year if you can do that every single day. So realize that when you can get those gains, take those gains, come back to the base and reanalyze your next target. Because you already hit that target, you got your HVI, you got the guy you were looking for, and you brought him back. He might not be the head guy, your $10,000, $15,000 10 banger that you wanted for, but he's a low-level guy that's going to give you enough information to go on to your next target, the money, because you need that money to go on to your next target. The more targets you bring in, the closer you get to those HVIs, because you're shooting those targets. You're going to get lucky eventually. All right. Analyze. Delta, time to expiration, profits, sell, hold, exercise option. So the entire time you're holding options, you're analyzing them because the market's going up and down. Again, we only want that $1, $2 trend, but say it breaks that $2 trend, now you guys start looking at it because start looking at the candles, looking back. Is this the last time it went up $5? And I look back in history and there's a 30-day mark where that's the last time the buyers and sellers argument. I'm going to hold for a second because I'm already in the money. I made my profit. I'm going to move my stop loss a little bit higher to keep those profits in. And then I'm going to wait for the buyers and sellers to argue some more. The moment someone wins, if the buyers win, I'm going to maintain because it's in my favor if I bought a call. The moment the puts win or sellers win, I'm going to get rid of everything I have. I'm going to pull my forces back because I don't want to risk my forces to lose more money. The trend's breaking back down. All right? It usually happens at support and resistance lines. So if you can analyze the candles and be like, all right, cool. My friendly advance into enemy territory is being halted right here. I can no longer go any further into enemy territory. I'm pulling back. I'm going to take my profits, wait for me to come back. More than likely, it's going to be your support line. And then I'm going to reassess because that's when me and the enemy are going to start fighting again. Once we go back into the target cycle, range, profits, everything's coming down, or range, pattern life starts showing me that we're going to break that trend again. All right, now we've regained momentum because we brought the artillery in, the volume, and I'm the buyer. Now it's going to break back up. And I'm going to buy here. Again, I'm going to do the same thing again. I'm going to wait for that breakout. Wait for about a percentage above, buy, and then look. 2 days ago, we went up 10. Today, I only needed to go 5. And now we're back at that line. So it doesn't matter, again,